On this episode of Newt's World, I'm talking with Anthony Esposito, founder and CEO of Island Capital, co-host of the Policy and Profits podcast about the recent stock market volatility, the Federal Reserve, and the tariffs. And as you can imagine, it's hard to be more relevant right now than those. Anthony, welcome, and thank you for joining me on Newt's World.
Mr. Speaker, thank you so much for having me. It's a pleasure to be here.
So, given your experience background, how do you see the current situation in the stock market?
The current situation in the stock market, and I was pretty vocal about this back in December and January. I write a morning note where I was very vocal about it. I was out on some TV hits and out on the podcast as well. We were seeing an overextended, over-leveraged stock market coming into December, January. My technical model, and I run a technical top-down model here, so I'm not looking at fundamentals, I'm not looking at earnings reports. I'm really watching price, momentum, and trend. I was watching those indicators in my model break down, and for the first time in a while, it was breaking down on not only my daily count, so that would be the quicker trade, but it was breaking down on the weekly and the monthly count. So the daily count quicker and more active, but also intermediate and longer terms. I was seeing what I was started to call in January as a topping pattern, which typically would occur as bull markets end and bear markets begin. That is exactly what we saw. Now, I know the headlines become interchangeable, and tariffs are a major headline, and this is a major discussion as it creates a lot of questions moving forward for the markets, for earnings, for investments, and for the economy. But I would say that right now we are moving through the beginning phase of a bear market. I think we took that 21% down move or so in the S&P cash. And now we're kind of seeing some volatility, which is extremely emotional and attached to, again, topics like the tariffs. And we are heading into earnings and so on and so forth. But I see the market as running its course through a bear market, which started at a peak of about 6,150, just above 6,100 on the S&P 500. And I see us in a process of moving down towards 4,200 or 3,700 on the S&P, in which that process will see a ton of volatility, very aggressive bear market rallies, which is nothing new, and some really heavy selling on days where the headlines don't work or where you have managers or hedgers just unwinding positions.
How much of this do you think was sort of baked in no matter who won the presidency, and how much has been made deeper by Trump's activity, particularly on tariffs?
That's a great question. I think, broad stroke, the market was ready and poised to fall regardless of who won. And I think a lot of that had to do with the policies of the previous administration. And what I mean by that is we had a GDP growth, a non-farm payrolls growth, and a market that was basically supported by government spending. And that in and of itself was a KFAB. It was a complete smokescreen. If you look at the percentage of jobs created that were directly or indirectly funded by the government or were direct funded government jobs, if you look at GDP growth as direct payments from the government, you were looking at about 80% of the jobs created were either funded by the government or low-paying services jobs. That's not where we want to be. And the adjustments down upwards of 1 million jobs at the end of the year that were never created, that were reported. If you look at GDP growth, we were looking at 50 to 60% of GDP growth directly or indirectly funded by the government. That was debt creation, that was tax dollars. So not only is that not real growth supporting the market, right, supporting growth and earnings, but it's also extremely inflationary, which is exactly what we saw. You can also go into consumer spending, which is a driver of earnings for the S&P 500. Consumer spending was also being driven by transfer payments from the government. So we had an administration that hid the fact that we were actually weakening as far as GDP growth, that we were weakening as far as manufacturing jobs, which have been technically in a recession for 2 years. And they hid that by spending, overspending, printing money, taking on more debt, and actually weakening our position, as they said or tried to present us as we were in a stronger position. What that did is it created a floor or a put for the market, and everybody played along. From the 2022 lows through the 2025 highs, we saw a narrative of AI, a narrative of continued growth, really pump through the markets and keep those models running and keep that narrative moving, when under the cover, we had really 7 names that were carrying the entire S&P 500, and it was on a narrative that was really falling apart. So the market, regardless of who won, was poised to fall. We were overvalued, we were overlevered, and the breadth was extremely narrow. Now, what I would say is, as we come out of the election and we head into this tariff conversation, which is the Trump conversation, remember, we had that massive rally coming out of the election, everyone ready for President Trump, for America First, for true growth, for a restructuring. But it's kind of like you don't realize the pain that you may need to go through to restructure. We have decades of problems to fix here, and our trade deficits, which I think is the real tariff conversation. Our trade deficit conversation is a 50, 60, 70-year-old conversation, and that takes time to fix. So where the market would have fallen anyway with a Harris administration, I think it would be falling into a bottomless pit. The market falling with the Trump administration is kind of the grind through, the cleanup of the problems left to him. And I've made this joke, and I'll say it because I think it makes sense. You know, clean up on aisle 7. We're trying to get from the Biden administration over to the Trump administration policies. So the process of fixing and changing policy to seeing the effect of the policy is messy. And the risk markets, the stock market, that's the mop. So as you're cleaning up the mess, all the dirt, all the grime, all the chaos is going to be in the markets. You're going to see it every day on the headlines. You're going to see it in the newspapers. You're going to hear it on the news. But at the end of the day, we're heading to a better spot under the Trump administration, whereas the Harris administration, I think we would have been heading into a bigger mess and we would have needed quite a few mops. So the sell-off was coming, but I think the pain that we're going through will be productive in the end.
I'm curious to get your reaction to this. I tell all of my friends, don't look at your stocks until August of 2026. That you're just going to have turmoil and you're going to get heartburn. But sometime around the summer of 26, my personal belief is that the investment boom and the various things will all have begun to hit. And all of a sudden, my guess is the end of the bear market will be in the spring and early summer of 26. What's your reaction just to that observation?
I think that you're pretty much spot on. I love your thought on the investments actually starting to take off. So I've said previously that the investments that were the onshoring of manufacturing, the onshoring of investments, and we've seen trillions of dollars coming in and be committed. Those, if you notice, those became the secondary, tertiary headlines, and everything became the tariffs. President Trump is crazy. We're kind of reverting back to the same old tantrums that we had. But what I believe will happen, to your point, Mr. Speaker, is as we come through the mess of the cleanup and the clouds kind of clear, we're going to realize that there is a massive amount of reinvestment, onshoring, and new investment in the country. And what that will do is that will create a V-spike recovery in economic growth in this country, in jobs growth in this country. I think the market will be absolutely on fire. Now, I say that, I think super insightful. I love the point you're making. I say that as an individual who's running a portfolio here under Island Capital. We are actually up 38% year to date as of this minute. I've been ahead of this and I'm really happy being short or long. For me, I don't care which way the market goes. My model doesn't care, which is kind of why I'm a technician and a CMT and I like to look at my models, my signals. I can basically work in a vacuum and the price and price action along with trend and momentum will tell me what's going on. I know if the news is good or bad or if the market looks at it as good or bad.
Are you significantly into gold?
I have. Gold is one of my 5 main areas or sectors of investment. Yes.
Because that has really gone way up.
It has. I actually had a call out in gold, to just be perfectly upfront. On December 27th, as gold was breaking above 2,600, I put out in my morning note, which is typically just the S&P 500. I keep it very simple. It's not my full model or my full universe. Everyone watches the stock market, so I write on the S&P 500. I put out a strong buy in gold and called for 3,000. It's been an absolute charm of the contribution, the attribution in the portfolio as far as gold goes. I can't complain about. It has gone way beyond 3,000 and way faster than I expected, but it's kind of worked with negative correlation to the market, right? As we've seen this fear really flow into the market quickly with this massive drawdown, we've seen a real rush into gold and into not only individuals buying gold and funds buying gold and retail buying gold, but more importantly, the sovereigns have been all over the gold purchase and chasing it up. So phenomenal move. And I think for all intents and purposes, we could see some consolidation lower to the 3,000 level, but I think it actually has more room to go to the upside.
One of the things I did notice is that the 10-year Treasury got to 4.41%, which I think partly tells you how much challenge they have in placing all the bonds. But how do you interpret where the Treasury notes are at and what the Federal Reserve should be doing?
So the move in the treasuries is interesting. I'm not sure whether it's a structural change in the debt market or whether it was part of a bigger unwind of what's called a basis trade in fixed income and in the treasury. So the basis trade essentially is you have a trade which is trying to make money, and it's a massively levered trade on Wall Street, and some of the largest multi-strat funds are in the trade significantly. You are essentially trading the basis of the 10-year or the bond versus the futures out on the curve. And you're trying to make a very little spread on a massive amount of investment, and that's where the leverage comes from, and that's where the trade unwind becomes that important. We've seen the 10-year now spike from 4% back up towards 4.4. The investors that were in, or the traders in that trade, were long the bond, and they were shorting the curve out and trying to make that spread. So now to unwind that trade, they need to sell the bond. As they sell the bonds, that spikes yields higher because there's an inverse relationship between price and yield. So I think part of the spike we've seen back up from 4 to 4.4, 4.3 today has been the unwind of that trade. I think that will settle back in, and the idea is it'll stay between 4 and 4.5%. I think it'll actually come in lower. I think with a change in some regulations and a change in the offering of the duration by the Treasury, I think that we will probably get more demand into the 10-year and will pull that 10-year yield down, which is something that Secretary Bessent has spoken about. And I was actually very happy to hear him speak about it a month or two ago, closer to 2 months ago, because the real cost of borrowing in this country is not correlated or directly related to the Fed and the Fed funds rate. That's the headline number. That's the thing that the stock market is constantly chasing. And the Fed has been very happy to be somewhat artificially supportive of the market, and which is not their role. The 10-year yield will determine more directly the cost of the 30-year fixed, the cost of a car loan, what you pay on your credit card bills, what you can go and get a loan at the bank, a personal loan at. So this is really should be the focus, in my opinion. Secretary Bessent is the first Treasury Secretary or the first member of any administration to speak about the 10-year yield in realistic terms versus the Fed funds rate. So I think that the 10-year yield will come in. I think there will be more support for the bonds. And I think, in my view, we'll see the 10-year yield closer to 3.5%, which will be beneficial for everyone as far as economic growth and also benefit the refinancing of debt for the government, which is a major issue. The Fed right now, if you'd like me to kind of shift gears and go to the Fed, I'm not happy with, and I've been vocal for whoever's listening with Mr. Powell, the idea of him being independent or not independent, or an independent Fed or not an independent Fed, has nothing to do with President Trump. I think Mr. Powell has shown himself to be very politicized and very biased. He has not performed well in his role, and I can go back to 2018 and speak about some of his rate decisions and asset purchasing decisions, balance sheet decisions, which have been very questionable. But most pointedly, to cut rates by 50 basis points, which was almost an emergency measure in September heading into an election, and then 2 more cuts of 25 basis points, was clearly political. There was no reason to do that. For a Fed that's quote-unquote data dependent, we saw a chair that was really making decisions that was, A, contrary to what a lot of members of the committee were saying, and B, made no sense. And now that President Trump is in office, He came out on the 16th and said he is not supportive of rate cuts. They don't see any issues. They're sitting on their hands. They have nothing to do. Like, his view and his actions are so illogical and so badly timed that the idea that he's not political or should still be in that role is actually crazy to me, to be perfectly honest.
In the old days, the job of the Fed was to protect the dollar. We then passed the Humphrey-Hawkins bill, which said, and they're also supposed to worry about unemployment, which I think made them schizophrenic. And I think we'd be much better off to go back and say, your number one job is to create a stable dollar and to take the steps necessary so that if I have $1 this year, it'll be worth $1 in 10 years. And that would be a very dramatic change from where we've been.
I agree with that. And I think that they are a major piece of that puzzle. I think that the Treasury, the amount of debt that was created under, again, Janet Yellen's watch, where Powell was completely silent. He had nothing to say about it. And in fact, he said, when asked, I don't comment on fiscal policy. Well, that stance has now changed since the administration has changed, but we'll leave that be. For him to watch Janet Yellen create upwards of $16 trillion in debt under her watch and not have any idea where inflation came from, and then say, as President Trump takes office, I know where inflation comes from now. It's President Trump and the tariffs. This is the problem. As Janet Yellen waved on the way out the door and said, hey, you guys might have a debt issue. Like, these are the things that make me laugh. I think the Fed would be better served, yes, focusing on price stability. And the idea would be that with price stability, employment will follow. The system does work. The ecosystem works. I think the Fed is confused in their role overall and how to accomplish their goal. And I would add to that, Mr. Speaker, that when I listened to Mr. Powell and Ms. Yellen speak about the environment, the ozone, equity in their deliveries, not that those things are or not important to me. I won't get into that, but it's not part of your mandate. This is not the ball that you need your eye on. I think they really have lost their way. So Secretary Bessent now at the Treasury is a great change of pace. I think that the Fed, to your point, would be well served to focus on price stability and the dollar.
I think Bessent is far and away both the most technically competent and the most stable member of Trump's team. And I think that he probably will carry us through all the tariff negotiations and all the challenges with remarkable skill. He strikes me as a very, very competent person.
There's no question. I've actually referred to him often, most recently, with poise. I'm from his world, and I understand what he's trying to accomplish and how he's trying to accomplish it. He has a massive amount of knowledge, and he has superb poise, which is something that we've been missing, certainly in the last administration. I mean, call it a free-for-all is probably kind. His poise and his expertise are just exactly what we need here, and I'm very, very happy.
The big, bold challenge of all this is the effort on tariffs. What's your reading on that?
So the broad stroke for me on tariffs is it is a conversation well overdue. We have a massive trade deficit issue, and I think that's more the issue than the actual tariff conversation. I think it's a very difficult problem to fix, as is any problem that's developed on a global stage over decades. But I think that all of the efforts being put forth by the Trump administration are certainly well thought out and well planned, regardless of how they appear, and will put the United States in a better position as we move through the resolution. I don't know exactly what the tariff rates become, but I do know that with our trade deficit at negative 3 to 4% of GDP, what we're essentially doing and have continued to do is we've transferred our economy from a manufacturing economy to a consumption economy. And by doing that, we're sending U.S. dollars overseas. So that trade deficit is important. It's not that it's not important and we're part of this beautiful global World Trade Organization where we're all happy and healthy. When you send dollars overseas, you're basically handing over our wealth to foreign nations. You're giving them investment funds, in the United States for them to come back and buy U.S. assets, whether those are hard assets in real estate, whether those are treasuries, whether that's interest in our stock markets or our companies. We are essentially transferring wealth away at a rate that's not healthy. A 3 to 4% of GDP trade deficit is not where we want to be. And we don't want to be purely a consumption economy. If we look at China, on the other hand, which is really a manufacturing economy and not a consumption economy, they're not consuming nearly what they manufacture and send out. I think the point to the entire trade deficit tariff conversation brings us to a place where we're reducing our trade deficit. We're reining U.S. dollars back into the country, and to your point, Mr. Speaker, strengthens the dollar. We don't want a slush of dollars out across the globe or within the domestic United States. That's not healthy for the dollar. That doesn't create a stronger dollar, it creates a weaker dollar. We want to rein dollars in, and we'd like a country like China to balance their economy with ours. So if they become a little bit more of a consumer and reduce manufacturing because we've now onshored manufacturing and we become a little bit more manufacturing, which is where we should be and what we are good at, we are the best. That starts to create more of a balance. And I would say that if, not to pick on China, but if countries like China abided by the rules of the WTO and actually played a fair game as far as intellectual property, as far as barriers, we would be globally in a better place. I think that not only globally in a better place, but the United States would be in a stronger, better place, which is the goal of the administration and the goal of the conversation. It's not a random argument. It's not random numbers. The tariff conversation and the trade deficit conversation for President Trump is something he's been talking about for 40 years, and it's part of a bigger puzzle, and it's part of a solution to a bigger problem, which ties right back into fiscal policy, monetary policy, what our manufacturing levels are, our consumptions levels are, the strength of the dollar, inflationary pressures. They're all connected. I think the conversation is a hard one, but one that we need to have, and we need to work through this process to become truly strong and truly better and see real growth here once again.
Has it struck you that we're seeing a lot more coverage of tariffs and almost no coverage of the scale of the announced investments? There are two Swiss pharmaceutical companies, between them, have announced $90 billion in investments in the U.S., just those two companies. And every time you turn around, there's either an auto company or there's NVIDIA's now putting hundreds of billions in. It seems to me that in the long run may actually be a bigger story than the tariffs.
I absolutely agree with that, and definitely in the long run, right? So this is what we were talking about before, where the pain of fixing our trade deals and fixing the policies that were in place prior will end, but then we're going to see this massive spike in real growth in this economy, in real growth in the market. It does not surprise me that the focus has been on the negatives of tariffs. It does not surprise me that there's a pile on. The idea that there are so many in the world, but more specifically in this country, that would rather see the negative headline and a failure on the part of the Trump administration, rather than see the Trump administration, because of the fact that it's President Trump's administration, succeed, is a sad commentary on where we stand as a nation. If this were flipped and it was the Harris administration creating all this turmoil, but working towards what they say is a better economy and more productive growth and fairer trade deals, we would see complaints, but we would not be seeing such lopsided reporting on what's going on. Again, there's a bigger picture here, and I give President Trump a lot of credit for ignoring a lot of the noise and grinding through, because at the end of the day, they are reporting negatively on everything that's going on, and we don't see the positive reports that are there. What will end up nipping them in the butt, as it always does, is when the tide goes out and we see what's really there, we will be in a better position. GDP growth will be stronger. The dollar will be stronger. The markets will be healthier, and employment numbers will be better. And this is why the country voted for President Trump and brought him back into office. The negative reporting, I can go one further for you. The negative reporting just on Tesla's earnings alone was absolutely insane. even from Wall Street analysts calling for the company now. All of a sudden, Tesla is, they're in a make or break spot. There are red flags everywhere. This is a rebuild story. A rebuild story. This is a company that made $19 billion in the first quarter. This is a company, they're the only fully U.S.-made car company in the world, premier technology, premier electric vehicle. 5 years ago, Elon Musk was going to put civilization on Mars. He was the darling of the left, and then came out and said, hey, I believe in free speech, I believe in the Constitution, I believe in a strong border, and I'm a patriot. And all of a sudden, he became the redheaded stepchild. So even there, the negative coverage of Tesla by analysts that have had buy and outperform ratings for 5 years on the stock was so biased and so transparent. It's illogical. I just don't know what to say about it anymore. It's just noise. Doesn't surprise me that they want everything to look bad. But at the end of the day, President Trump, the administration are doing the right things.
What struck me watching Tesla over the years is Tesla's actually an information company with cars, because the sheer volume of data they're generating is so enormous that as you get into artificial intelligence and you're looking for databases on which your new artificial intelligence can train itself, Tesla's going to have an enormous advantage in just the sheer volume of real data about the real world, because their data is not just theoretical. I don't know if that fits at all your vision, but I think of them as a very interesting and very different long-term play.
I agree with you 100%. And I think that's a great view and another angle to look at the company. I mean, not only an information company, as you said, or data company, but you're looking at the battery technology. You're looking at reusable, renewable technology. Now you're looking at AI robotics. Like, the company is just beyond exceptional. Now, I don't invest here in individual names. I'm in the future space and I am macro top down. But I would say that Tesla, as the street has turned negative and have been pressing the name for clearly political issues, which is insane to me, I think Tesla right now is probably at one of the most attractive levels. It's a very attractive entry level for the name. And ironically, it's when the street has turned and is calling the name, on the brink of extinction. It's just insane to me. But the company has a lot going for it. And look, Elon Musk, he's so highly functioning that this whole play was to pull him from Doge. They wanted him out because they feel like he is the tip of the spear in uncovering the waste, fraud, and abuse. So maybe they accomplished their goals, as he announced it in the earnings call. As of May, he would be stepping back. I think he leaves a capable team in place, and I think that that's irrelevant. The company, yes, to your point, is multifaceted. There's a ton there, led by one of the all-time geniuses in history. You can't really argue that point.
People don't notice, but SpaceX continues to grow and evolve. Starlink continues to grow and become more profitable. Neuralink may have breakthroughs that are extraordinary within the next year. I tell people he's sort of a cross between Henry Ford and Thomas Edison. I mean, the sheer scale of his ability to think things through is really pretty bizarre. You don't see these things more than once or twice in a century.
Agreed. I love the fact, to that point exactly, that the analysts are saying, well, he's taking too much time on Doge. He's not paying attention to Tesla. He's running five massive companies. No one has a problem with it. But he steps into Doge and he's working with President Trump. All of a sudden, he can't do that. That one chip was one too many on the board. He's not going to be able to handle this.
In general, what are you telling your clients about the markets right now?
My clients understand that my view for the intermediate term and longer term here is that we have lower lows to make before we recover and start to move higher from our previous peak. With that said, my technical model is giving me a positive, a neutral, or a negative on all of my asset classes in the universe. The investors know that we may not be participating on these rallies as we're seeing today, but I am more inclined to be selling my negative calls because that's the greater move for me. These moves will reverse quickly. For as aggressive and attractive as they are, they will reverse quickly to the downside. So they understand that we are basically playing the market flat to short until our downside targets are achieved. And then we'll start to play the market on the recovery. And again, with that V-spiked recovery where those investments are now acknowledged and starting to take hold, I'll start to turn and I'll see my intermediate and longer term signals start to flatten out and become more bullish. And then I can start playing the daily trades higher. I've been playing the market flat to short since December. And I can tell you that for the year to date, we're up going on 40% now. So the investors are happy, I'm happy, and I think that there's a way to make money in both directions as long as you can look at the market objectively and have a process that works, which thankfully I do. The problem that investors run into and funds run into is they're trying to manage on a fundamental model which is broken. So then they grasp at straws because there is no earnings growth. You don't know what the numbers are going to be. You don't know what the guidance is, and the model falls apart. So for me, investors understand right now I am neutral to bearish. I'm not chasing these rallies. I'm a seller of these rallies. But when my model tells me, okay, the dust is cleared and we've bottomed, and I may be in a month to a quarter behind that. I may not jump in as soon as there's a turn, but they realize they'll start to see on the monthly and quarterly statements the long exposure as this thing bottoms out, and my model's telling me it's time to start to take some long exposure.
You're certainly very smart, and you certainly know an immense amount about the economy. How can people get your newsletter?
So my newsletter is out at islandcapitalinvestments.com. It's a free newsletter. You can see all of my deck, my investment process, and you can sign up for free for the newsletter there. I'm also on X at CMT_Anthony. That's Chartered Market Technician _Anthony. I have all of my media out there. I have the podcast out there with EJ and Tony, Policy and Profits. The newsletter's posted every morning. And then as I see something during the day, I may throw something out just to give a heads up. But I'm definitely out there. The information is free. I like to share that information and be open with it. I'm actually, Mr. Speaker, going through a cap raise effort now and a restructuring of the fund. So hopefully in the next 3 to 4 months, I'll be launched in a different form, potentially with a different name. But it'll all flow back towards islandcapitalinvestments.com and at CMT_Anthony.
I must say this has been very impressive. I mean, I really appreciate your knowledge of the market and your candor and the model that you use. I want to thank you for joining me. I do encourage our listeners to check out your website at islandcapitalinvestments.com, which I'll tell you flatly, I am going to sign up for this afternoon because I very much agree with your general approach to the economy. And thank you for joining us.
Thank you for having me. It was an absolute pleasure.
Thank you to my guest, Anthony Esposito. You can get a link to his company website, Island Capital Investments, on our show page at newtsworld.com. Newt's World is produced by Gingrich 360 and iHeartMedia. Our executive producer is Garnsey Sloan. Our researcher is Rachel Peterson. The artwork for the show was created by Steve Penley. Special thanks to the team at Gingrich 360. If you've been enjoying Newt's World, I hope you'll go to Apple Podcast and both rate us with 5 stars and give us a review so others can learn what it's all about. Right now, listeners of Newt's World can sign up for my 3 free weekly columns at gingrich360.com/newsletter. I'm Newt Gingrich. This is Newt's World.